All right, we're going to look at one of the safest trades that you can make. We're going to look at covered call options selling for premium. This is Western Digital. You guys know this is one of my favorites. One, because it's a pretty solid company, and two, you get pretty good premium for selling options here. So let's look at this trade. Let's go to Trade Lab, build strategy. Okay. Let's say you want to sell a call. Okay. This selling a call means you're obligated to sell at a certain price. So if I'm obligated to sell at 34, then if it were to post right now, if it were Friday, then I would lose $10 because it's 100 shares each and I'm selling at 34 and it's currently trading over that. So whoever bought this option would gain $10 because it's on, or $9 now. All right. So this has unlimited potential for loss. And the reason why is because if I sell this call at 34, I don't own the shares. I would have to go buy the shares. So let's say this goes to $100. That means I would have to sell it at 34, go get them at $100 and sell them at 34. That's a loss of $66 per share times 100. So that's a massive loss. So why is this the safest trade? Because it's called covered call. If I were to sell this, this would be an uncovered call. Okay. That's one of the most riskiest. Uncovered call because it's max exposure. Okay. So let me add a stock position. Let me say I want to buy at the current rate. Oh, sorry. Buy a stock option. I want to buy 100 shares because options are in 100 share lots. Let me say I want to buy at the current price at 34.04, but I want to sell my call at 34.50. So I have the shares at 34 at the current price, but for Friday, May 12th, I want to sell the 34.50 call. This would lock in $50 of profit, so it's 50 cents per share, plus I get $30 right off the bat. All right. And if this triggers, what ends up happening is I have to sell at 34.50, which is no problem for me because I get the profit from here and I get this premium. If this doesn't trigger, if this expires, which means it doesn't go over 34.50, then I have shares at 34 and I could sell another covered call for May 23rd or whatever, any one of these dates. So this is going to automatically debit me 33.74. The reason why it's 33.74 is 3,400 I'm spending right off the bat for the shares, but I get $30 back for the premium, immediate premium. So that's why it's 33.74 because it's minus the premium. All right. So let me save this strategy. See how it says covered call? System knows that it's going to be a covered call. So let me save this strategy and take a look at the losses here. All right. Max profit is the $76, and that's the $30 plus the $40 in premium, or $30 in premium, $40 in appreciation. My max loss is 33.74, and this is the shares going to zero. So this is zero chance that it's going to zero. That's why you use profitable, or that's why you use good companies. And then the max profit it triggers is 32%. So see how my risk to reward is 2%. And I want to look between 1 and 2% because it's relatively safe. See the 60% here chance that for any profit? That's what I'm looking for. Now the person who's buying this call, so they want to buy it at 34.50. They think it's going to 35, and so they're buying a call at 34 for $34. All they're spending is $34, and they think it's going to go to 35 or more than 34.50. So they can buy the shares at 34.50. They have the option to buy, and this only costs them $29. And they can sell at any price over this. Okay, so their difference is the spread, and it only costs 34. So let's see what this strategy looks like. Infinite max profitability, and the reason why is this share. Let's say the shares go to 100, then they get the difference between 34.50 and 100 per share times 100. Max loss is only the $34 to buy the option, so it's like a coupon. I have a coupon to pay for milk for $2. Okay, and their break even is $34.84. So they'll get their premium back if it trades at $34.84. So this is why this is so popular. Buying calls and selling calls is because, or buying calls is because it only costs you $34 and you have the max profit. Okay, but look at the probability for loss. It's almost 70%. Now I have the capital, so I want to sell them this. It's like a scratch off ticket. The chances you win on scratch off ticket are very small, but when they do hit, they hit big. Okay, they don't have very much capital, so they buy a little scratch off. I have the capital, so I'm basically selling the scratch off. Hope this makes sense. That's a covered call.